Hey everybody, welcome back to the channel. Today we've got a great topic. We're talking about pizza. That's right, pizza. I hope you're hungry. No, but seriously, today I want to talk about stock splits. Tesla and Apple both just did some high profile stock splits back in August, so figured now is a good time to touch base on the subject. Before we get started, you guys know the drill. If you haven't done so already, or this is your first time here, please like and subscribe below for all of the updates and the new videos that come out. Try to do these every week. Okay, so let's get back to the pizza, because I know you all are hungry. So I'm going to use pizza as the analogy here for a stock split because, oddly enough, it's really like the same concept. You have two of the exact same size pizzas, right? So you've got pizza A and pizza B. They're the exact same size. Well, what if you cut pizza A into 8 slices, but you got a little crazy on the pizza slicer and you cut pizza B into 16 slices? Do you have more pizza on pizza B? No. The answer is no, you don't. You just have more slices, and that is the exact same concept with a stock split. I'll just use some numbers here as a quick example because you guys know, if you've been watching the videos, how much I love the numbers. We'll use a company that has a $100 billion market cap. Let's say they have 100 million shares outstanding. Their price per share is going to be $100 a share. Now let's say that same company does a 2-for-1 split, effectively doubling their share count to 200 million shares versus 100. Still a $100 billion company. Their share price is now $50 a share. You can do this, it's simple division or multiplication, depends on the ratio of the split, reverse split, but you know, whether it's a 2-to-1, 4, 5, 10-for-1, doesn't matter. It's all really just a simple math concept and an accounting maneuver. Why do companies do this? Well, stock market folklore says that it was to appeal to, or it is to appeal to retail investors. So the psychology here is buying a $50 per share of stock is a lot easier to do than buying a share of stock that's $500. Yes and no. I guess I kind of get that, but you know, if you want to invest in a company, regardless of the stock price, you know, you need to do what you have to do to have the cash available to trade it. I'll get to why that's really not as relevant in today's market at the end of the video. Similarly to the stock price, I think another reason why this becomes more marketable to a broader range of investors is option pricing. So option prices on a $500 stock, I'll keep using that as an example. The price per contract for a $500 stock is going to be enormously more expensive than what a $50 stock would be. This again appeals to the retail investor, whether they're trying to put hedges on, buy some puts, maybe buy some out-of-the-money calls to participate in future upside. The price per contract for that $50 stock is going to be a lot lower. Lastly, for a possibility of the split, I'll use Apple as the most recent example. So Apple was added to the Dow Jones Industrial Average, which is a price-weighted index, meaning each constituent has the influence it has on the index is based on the price per share of each company in the Dow. Well, with Apple creeping up $500-600 a share, you can kind of see how that's going to have a much bigger and outlier effect on the price of the overall Dow index versus the other constituent companies in there. Doing the split gets it back down to 100, give or take, $100 a share, brings it back more in line with some of the other companies in the index. Want to talk quickly about reverse stock splits, which is the exact opposite. So instead of increasing the share price, shares outstanding and reducing share price, you are reducing shares outstanding, increasing share price. This is typically always, not every time, but typically for the most part, this is usually around some kind of negative event or environment for a company. They're trying to not be delisted from an index they're on. A lot of indexes have minimums of $5 or $1 per share requirement. So you can see as they drop towards 5 or below 5, they start to do the reverse stock splits to try to remain included in the index. Last thing I want to talk about is in creating new share classes. So not necessarily stock split, but Alphabet, Google, the old Google, now Alphabet, did this in 2012. They created what's called a C-class non-voting share while also creating an A-class voting share. Why do they do this? Some companies do this because they want to keep the upper management, the executives of the company, in power as far as voting goes. So they want them to have the majority of the voting power for the stock. It doesn't really have a huge effect on the future of the business prospects. You just want to make sure that you understand what management's motivations are, why they're doing that. Some managements that we've seen over history don't really have shareholder interest aligned with themselves. Lastly, I just want to talk about a question I got a lot during the Apple stock split. Clients and friends were asking me, do I have to hold the shares of the stock before the record date to be a record holder? Well, yes and no, you do, but you don't. If you want your shares, if you want to own the company and you want your shares to actually split, you want to see them split in the brokerage account the day of the effective date, buy the shares before the record date. But if you want to wait and you just want to buy the shares after the split, assuming you're going to use the same dollar amount you were going to purchase the shares with, regardless of the situation, just buy Apple stock. It doesn't really have any effect. To summarize here, please, I want to emphasize that stock splits really have no inherent value on the company, the future prospects of a company. So I know it's a very hyped up, high profile, high media event that goes on, especially with companies like Apple and Tesla, like we just saw a couple months ago. But please, I just want to emphasize, it's really more of an accounting maneuver than anything else. If you want to buy a stock, you believe in its future prospects, you buy the stock. I want to really quick circle back to what I had mentioned earlier about the relevance and the meaning for these stock splits. Nowadays, online brokers are allowing you to buy slices of stock. So Amazon, Google, you can buy slices of shares. You can also buy ETFs. Everyone, ETFs are an amazing, cheap way to get exposure to broad sectors, technology sectors, software sectors, cybersecurity. They have an ETF for every subset of a sector that you could think of. So just do a little bit of homework, send us an email if you have some questions about some of the ETFs, but ETFs are a great way. Okay, thanks guys. Always appreciate the time. I know all of our time is valuable, so thank you so much. We look forward to seeing you on the next video.